Okay, we are starting and hitting the record. The record has started. So I am going to be talking tonight about the stock market, in particular, actual accounts within the market that you're able to use. So these questions are going to be retirement investing, accounts. We're going to be talking about investing for your children, other investing, and all of that. So we're going to center this around account specific topics. All right. So first things first, I'm going to go ahead and start from play from current slide. All right, there you go. All right, guys. So investing for retirement. This is the biggest topic. Most people are like, "Hey, I don't know where to begin." It's something that's kind of the bedrock and foundation of personal finance that we need to make sure that we are set up for. One of two reasons. One, because everyone thinks 65 or 59 and a half or whatever it is so far away, but it really isn't. Think back to when you were 10 and now you're 30 or something. That's 20 years. It's quicker than you think, and people are living longer than ever. So to be prepared for this, 65, 59 and a half, you might still be fairly young. And at that point, you want to at least have yourself set up to where you don't have to rely on working and that you can just rely on, on your investments. So having this set up is important. And we'll talk about other things outside of retirement, like I said, but I think that this is the foundation, making sure things are set up. So let's get into some of the accounts specifically. So the 401k is the biggest one that most people are going to be talking about. When you hear retirement, people talk about 401ks all the time. For other people outside of a typical employee-employer relationship, like a not-for-profit, a governmental employee, stuff like that, they're going to have different options, but they're all relatively the same thing at the end of the day, which is basically a defined contribution plan. So the common characteristics of here, we have the 401k, you've heard 403b, 457b, TSP or thrift savings plan. These are all an account that you say, hey, I'm going to put a X% in. Let's say that's 10% of a $50,000 salary. Okay, we're going to put $5,000 in per year, and you'll set that and forget it. And that will be taken out of every type of paycheck. So that's kind of what defined contribution means. These are very tax favorable accounts. So there's part of it that irks me that the government makes, holding your money into this account that you can't touch till 59 and a half extremely tax favorable, because it's a benefit for them. It's a governmental asset to them. So when you have your money locked up, it's beneficial for them. So therefore they're going to give you a lot of, incentives to keep your money in these types of accounts because it's out of your hands for quite some time. You can say what you want about it. There's pros and cons to it, but ultimately very tax favorable. A lot of these accounts, so when you go out in the market and try to buy and sell shares, it can be it can greatly vary with the type of account that you're getting in with the investment options within that account. So if you're in a taxable brokerage account, which a lot of you guys probably are, if you're in the Wealth Squad, buying, selling securities, you're going to have access to pretty much everything. But in these 401ks and 403bs, these are plans that a company let's say, you work at Apple. Apple is going to go purchase a 401k plan through, let's say, Vanguard or a big brokerage firm, Fidelity, Charles Schwab. And they're going to say, hey, we're going to select this basket of funds, these investments, and this is what our employees are going to be able to invest in. So that you can't just go buy whatever. And this is why I do not like 401k plans comparably to the IRA, which we'll talk about in a second, because there are limited investment options as well as high fees. So the average investment in fees that you pay in a 401k throughout your lifetime is about $138,000, which is extremely high. So we have to be very aware of fees in these accounts. I talk a lot about fees, investment fees in general, but 401ks are known to have huge fees. So be very careful with that. I would hate you guys to get $138,000 in fees for nothing. Usually it's a click of a button on a few things. So the thrift savings plan is a little different than the other three that we mentioned above, just because the investment options are a little different than traditional. So like I said, your company is going to go out and purchase a basket of funds. Well, the TSP is a little different. It actually only has 6 funds. So I listed them here, and it makes investing much easier. The less options you have, the easier. So you have the G fund, which is government securities, F fund, fixed income like bonds. You're looking into the C fund. So you would think of common stock just like an S&P 500 type of fund. S fund, small cap. So, small companies in the United States that have a market capitalization of less than $2 billion. And then you have the I fund international. That would be like a VTX, for example, at Vanguard, like an international index fund. And then you have the lifestyle fund, which is a mix of all, which you could think of like a target date fund in like a 401k. These are all good options. Everybody's situation is going to be different. So you can't necessarily say, hey, what's the best pick here? Because, somebody that's 25 and getting started might go in the C fund, but somebody that's 55 and near retirement might want to go, more F fund and C fund or something like that, just because of the level that they're at. So in 2020 and 2021, there are caps, and there always will be caps from the IRS perspective to say, hey, in these accounts, you guys can put X amount of dollars in. For the accounts we've talked about, $19,500 is the limit that you're allowed to put in per year. So if you want to put in 20,000, you are not allowed to do that at this point. The IRS kind of keeps up with inflation, so they'll increase these limits with time. If you look back in like 2016, the limit was like, I don't know, maybe 18,000 or something like that. So they continually increase. What's called the catch-up contribution. So if you're above 50 years old and you're like, I need to get, caught up on my investing, I'm kind of feel a little bit behind. Well, you have this catch-up contribution that allows you to actually invest an additional $6,500 in 401ks. So my parents, for example, are 54, about 55. They are basically a little behind in retirement investing. They didn't get off to a hot start. They didn't know about this stuff. And now they're sitting there at 55 and they're like, well, we need to catch up. So they're putting in 25,000. They're trying to max it out right now to catch up because they're so far behind. So never feel as if like you can't catch up. There are catch-up contributions like that. The other account that's really big for retirement is what's known as the IRA. And so like the 401ks and all the other ones are government sponsored or employer sponsored. This is not employer sponsored. So when you start a job at, your 9 to 5, they're not going to say, hey, here's an IRA. With a 401k, they'll say sign up. But the IRA is something you have to go out on your own and go get. So I talk about this a lot in my book, of like step-by-step of opening the IRA. But with this, you'd have to go to like a brokerage like Vanguard, Charles Schwab, Fidelity, like I've talked about many times, and actually elect to open this IRA account. So this is on you personally to go do this. Your company is not going to push you to do that. This is my favorite account because, again, it's very tax favorable, but it also has great investment options because it's not limited to that basket of funds that, the 401k and 403b and stuff are limited to. They also have lower fees than the 401k typically, as well as you're not going to get nickeled and dimed with the actual funds themselves. A lot of times within 401ks, the investment funds themselves might have a really high expense ratio, and there's no way around getting out of that. But with the IRA, you can select funds with whatever expense ratio and the lowest fees possible. Like Fidelity has what's called FZ Rocks, which is the total market, which is essentially zero. It's free. So that's something to be aware of between the IRA and the 401ks. The 401ks are kind of provided through work, whereas the IRAs are, on your own. So with the IRA, same thing as, the 401k, you have the catch-up contribution, the regular contribution limits. But with this, there's a lot lower of a limit. So 6,000 is what it is in 20 and 21. The catch-up's only $1,000, so $7,000 in total. And that is kind of what I recommend to, max out. I often say, the order of operations for investing for retirement, I'd say start with your company match in a 401k. So if you have a 401k and the company matches, let's say 2%, 3%, invest up to that to begin with. Then move on to the Roth IRA. Let's say you hit $6,000 per year and max it out, and you have some money left over. Then go back to the 401k and invest it into there. I often say 15% of your gross annual income is a really good starting point for retirement. Some people will say 10%. The financial industry kind of varies 10 to 15%, but the higher the better. So I always like preparing for retirement to make sure you have enough funds, and 15% is going to get you there. So this is a big talking point that a lot of people aren't fully, don't understand this entirely. So a lot of people will say, hey, have you opened a Roth? Have you opened a traditional? But that doesn't necessarily tell me which type of account you've opened. So like we've talked about the IRA and the 401k, well, those both can be traditional and those both can be Roth. Some 401ks are limited to just traditional, but for example, mine at work, I can go traditional or Roth, and I've opted Roth or after tax. So what does this mean? I like to use the example of saying, like, if I walked up to you and I said, hey, I have a blue, you'd be like, I have a blue what? Well, I have a blue coat. Okay, that makes more sense. So if I say I have a Roth, well, I don't know if you're talking about an IRA or a 401k. So a lot of times people don't understand this is a tax designation more so than the actual account itself. So traditional is pre-tax. What this is tax that when you get your paycheck from work and you're putting it into a 401k, you can say before tax, I want to contribute X amount of dollars into the 401k. That money goes into the 401k. It grows tax-free for 40 years or whatever, whenever you actually withdraw it. And then at withdrawal, you actually are going to pay the tax then. So whereas the Roth, it works kind of in reverse. So you actually pay the tax now. So let's say you get your paycheck. Well, you're going to get your paycheck and taxes are going to be taken out, and then you're going to get your net income. Well, then the Roth, you're saying, hey, now I'm going to contribute that money after tax. And then you're going to put it into your, IRA or 401k. That money is still going to grow tax-free, like we were talking about, tax favorable for 40 years. Then you get to retirement and you say, hey, I want to pull of this $2 million account, $100,000 is tax-free at that point. And so that's why I typically say the Roth is more my recommended route to take. There's some rules around this of, income limits, in an IRA, if you make over a certain amount, it's, I think it's 125,000 to 137,000. The phase out starts at 125. If you're single and if you are a married filing jointly, your income, it starts at like 195, I think, and phases out at 206. So if you make over that modified adjusted gross income, which is a big difference in just annual income, because you'll have like a standard deduction that's taken out 24,000 approximately. That MAGI, which is modified adjusted gross income, is what is considered your income limit. So if you make over that, after that, you have to actually contribute into traditional. However, you can take into what's called a backdoor Roth IRA, which is kind of a tax hack. It's completely legal, part of the tax code. So what you do is contribute into traditional, and then you basically take that money and convert it to Roth, which is called a backdoor Roth, and pay the tax right then. So you kind of still have the option to always do Roth no matter what your income is. I also think tax rates are at the historical lows, and I don't know 40 years from now what they're going to be, but I'd rather pay tax now personally, take the hit now, and then in retirement be able to enjoy that money entirely. So that's kind of retirement in a nutshell. Pretty basic for the average person. With the children piece of it is a lot different. So these accounts are, nothing's through work like the 401ks. A lot of people just have a 401k because it's provided to them through work. Investing for children is a different animal. So here are 4 different types of accounts that you can use to invest for your child. And each one of them are going to be kind of different as to the usage and all that kind of stuff and, the purpose behind it. But you have the 529, the Coverdell Educational Savings Account, ESA, the UGMA or UPMA, and the Roth IRA. So a lot of people don't know about this Roth IRA down here, but this is a huge hack. But I'll walk through each one of these. So investing for children. So 529 and ESA are the most standard accounts for educational purposes. If you want your kid to go to college, if you want your kid to go to trade school, all that kind of stuff, this is exactly where you're going to do it in these 529s or ESAs. I often recommend to do, in a 529 over the ESA, but I'm going to break it down, kind of the similarities and differences. So they're both used for education. They are tax advantaged. So what you put in this account will grow tax free. And when you withdraw it for educational purposes, which are qualified medical or qualified educational expenses, you will withdraw that tax free as well, which is a benefit. Also, if you have let's say you have 3 kids, the first one decides not to go to college, or let's get a full ride scholarship, you can transfer it to siblings. Also, if you have a scholarship, you can withdraw that up to that amount tax free as well, so you don't get kind of pigeonholed into, hey, I saved all this money, now my kid has a full ride, and I don't want this early withdrawal penalty down here of 10%, which comes with if you take it out for anything other than education. So be very aware of that. The differences are the contribution limits, which is pretty big. The ESA is a $2,000 contribution limit, whereas the 529 really has no limit. I think there's technical limits on these by state, but they vary and they're like extreme. Like I want to say 300,000. I've seen Kentucky or something crazy. So there's basically no limit for that. And then the ESA, so once the beneficiary turns 18, there's no more contributions allowed. But the 529 works differently. So if your kid's 18 years old, goes to college, you want to hold this money and kind of benefit from the market returns until 22 when they graduate. You can do that with the 529, so it stays in the market a little longer, and there's more growth on your investment. So those are the kind of educational side of things for children. The other side of things is hey, I want to save for my child, but I don't really necessarily know if it's going to be for education. They've voiced that they want to be an entrepreneur. They've voiced they want to, I don't know, work as a car salesman that you don't have to go to school for, some job that's not technically for school. And this is an awesome way to do this. So the Uniform Gift to Minors Act, which is often called the UGMA, or Uniform Transfer to Minors Act, which is often called the UTMA, these accounts are really, really strong accounts. So this is basically a brokerage account, a custodial account in the name of the minor. The account becomes the minor at age 18. And so that's where, there's some hiccups with a lot of parents, and we'll get into that in a second. And then there's a $15,000 per year contribution limit into these, which is a lot of money, especially if you're starting young. The difference between the UTMA and the UTMA, we kind of use these interchangeably. It's really just the UGMA is the securities, so you can buy stocks and bonds and stuff. The UTMA is securities, but it's also real estate, fine art, patents, and royalties that you can also contribute to them as well. So those are the differences between these two, but ultimately this is essentially a custodial account other than education. So this is the big debate a lot of parents have. I know Sean, the Wealth Dad that you guys see, and he's one of the moderators and educators in Wealth Squad. He had a presentation specifically on 529s and college savings and all that kind of stuff. And 529s are awesome options for education, but a lot of parents are like, hey, I want to give my children money, but not for education. So they kind of lean towards the UTMA and UGMA. But the problem a lot of parents have is, hey, this money becomes my child's at 18 or 21, depending on the state. And when you have that situation and you're starting at, the ripe age of when they're born, let's say 0 years, well, how do I know what my kid's going to be like at 18? Do they deserve this money? Do I want to put this money in their name that I know is going to be theirs, for sure? What happens if they go down the wrong path? Quick story is my uncle did the UTMA. He used the UTMA as, the option for his child. And she's 16 years old and she went off the rails and basically left the house. And that money, he doesn't have a control or say on it, which is a major issue in his. So he's stopping contributions because he doesn't want her to, he's not going to continue to contribute for what she's done, but she's out of the house. So at this point, he's kind of stuck with this money becoming hers at the age of 18, whether she likes it or not. I often tell parents, don't tell your children that you have this savings for them. Yes, they have a social security and they're going to get emails at the age of 18. And if they're smart enough, they're going to figure this out, that it's probably their money. But there's a chance they don't, if they don't deserve it. However, I mean, most times your child's going to turn out, good or at least decent, you would hope. And you're going to be comfortable with giving them this money. And as long as you teach them the right principles along the way, I think it shouldn't be much of an issue. So this is a big thing. So I have a little emoji guy here. So didn't you say a Roth IRA could be used for my child too? So yes. So a Roth IRA is a little different in the sense that it's not meant for at 18 years old for them to kind of take out. There are some exceptions that you can use, such as like a down payment on a house that you can pull that money tax free. And you can look those exceptions up. I don't remember them all off the top of my head. I think there's about 5. But basically, a Roth IRA, you could start this at a young age for a child. They have to have earned income, but assuming they have earned income, you can definitely start putting money away for them. And if you start at like, let's say 5 years old, and I don't know, they're helping out with, so if you're a business owner, a lot of you parents are business owners, think about ways that you can employ your child so that you can pay them technically through the business. And then they can contribute into the Roth IRA. That's a huge hack. So if you run an online business, printing or shipping, if you run an Instagram business and you use them as a model, literally a model, there's a lot of tax law around this, but basically it's as long as you can claim them as somewhat of an employee, you can pay them. If you pay them, you can put this money into a Roth IRA. That's one way. Also, let's say they file earned income from they're 9 years old, 10 years old, and they're shoveling driveways, cutting grass, doing things in the neighborhood and stuff. Well, they can actually claim that income, file with the U.S. government, IRS, and then put this money away in a Roth IRA, which would be huge for them. Because if you start this account at 5 years old, 10 years old, that money is going to be growing until retirement at substantial. I mean, they will be very, very wealthy at the age of 65 when they tap into this. So the other investing outside of children, there's a few things. The biggest one's the taxable brokerage account. This is the most, I mean, there's a long definition right here you guys can read as I'm talking. This is kind of the technical definition, but essentially this is a regular account in the open market. It doesn't have the tax advantages that other retirement vehicles and investing for children might have, but this is what I like to call like the freedom fund. So this is something that you can tap in whenever. You can put your money in there and you can withdraw it and you can take it out whenever. There's no tax penalty necessarily, but the money that you put in as it grows, it's going to, incur capital gains, and you'll pay a capital gains tax on the sales that you incur within the account. If you sell within a year, they're going to be short-term capital gains. And if you sell with over a year, they're going to be long-term capital gains. So this can be opened through any brokerage institution. The account goals can vary greatly. Like this is just somewhere to put your money. If you're like, hey, I don't want to keep it in a savings account. My savings account earns 0.06%. I just made 10 cents on last month's interest. So I want to put my money somewhere else outside of my emergency fund. Let's say you have a down payment on a house coming up in 5 years. This is a perfect place to put that. This is an early retirement vehicle that you can use. So myself included, we're using this vehicle for early retirement. So essentially we're going to be contributing X amount of dollars per year, putting this in there, and then hopefully, letting that grow and sit for 20, 30, 20, maybe, at this age, 15, 20 years, and taking that out and living on that until retirement, and then accessing our retirement funds at 59 and a half. So knowing your taxes is huge here as well. Like I was saying, the capital gains, and I have a slide, I think in my last presentation, I went over exactly the details behind this tax, everything that's incurred with this, short-term, long-term capital gains, there's dividends, there's interest income, they're all taxed a little differently, but refer to that presentation for the details. But essentially it's capital gains, which is 15% for most people in short. So this is the holy grail of investing, in my opinion. So the HSA, and this isn't available to everybody, but for those that have this, basically the only requirement that you need for an HSA is a high deductible health plan. So if you have a health plan through work of some sort and it's high deductible, you can open an HSA. You don't necessarily have to have one currently. You can literally just open one whenever. The company I I affiliate for is First Dollar. So they have an excellent health savings account that you guys can get in. If you just DM me or whatever, I can give you the link to that. So if you have a high deductible health plan, you don't have one currently, you can just go open one wherever, literally banks, institutions, wherever, and just start that instantly. But why is this account so good? So there's what's called the triple tax savings. So what you contribute is tax-free. So you're putting in money before tax. Then investment earnings and interest are tax-free. So your growth in the account's tax-free. And then if you use it for medical expenses, let's say you go to the doctor, you can pull that money tax-free and with no penalty. So this is a awesome benefit from a tax perspective. Like there's no other account that offers these, tax benefits. So there's a little more to this, and let me show you kind of the retirement hack or another hack I use. So when you go out to your doctor, let's say you go to a doctor visit and you have an HSA, but you decide not to tap into it. So let's say you have $1,000 in the cash fund, and then everything else above that is invested into, I don't know, a low cost index fund, such as like the Total World Stock Market Index, and it's just sitting there growing. Well, if you come down to a medical bill and you decide to pay it out of pocket, like you just swipe your debit card, credit card, and pay that medical bill, save that receipt, and you can and make sure you save it because there has to be proof of essentially. A lot of these HSAs allow you to upload the receipts, pictures of the receipts into their portals. But what I do personally is I save my receipts and put them in an email folder, because in the future, I'm allowed to withdraw that money tax-free because I use the HSA or use my personal dollars for medical expenses. So therefore I can withdraw tax-free at any given point in time in the future for that. So I like to let it sit there and earn a bunch of money. And if you are in the position to do that, this is an excellent way to, start building for the future, because the average person spends about, after 65 years old, $365,000 in medical expenses. So to have, an account that's growing for you to kind of be there at retirement is a huge hack if you're able to do so. There's also like FSAs, flexible spending accounts. Those are through work, and those are use it or lose it. So those are another option for medical as well. I don't talk about this often just because it's, you can contribute to it, but the thing is, if you don't use it at the end of the year, it's lost, and your company contributes X amount as well. So that's the end of my presentation. Those are the main accounts that, I'm focused on when I'm looking at my, balance sheet and stuff. Where can I put my money? What can I do here? But I want to open it up for questions. So I know there were some questions in the chat box that probably came through. I'm going to go back and make sure I cover all those. All right, so let's start up here. Appreciate the kind words, guys. The dog. What's up, y'all? Take this in. Budgetdog's a legend, okay? Okay, so here's the first one. Do you have to have residency to set up a Roth IRA? No. So it doesn't matter. I think that means like, are you like located here in the United States? You have to have an earned income. That's the only stipulation behind this. So as long as you have, some sort of income that you're filing with the IRS for tax purposes, that's the only requirement. And then you can set up the Roth IRA today. In my book, guys, you can go to Vanguard, and I'm going to be honest, you can call customer service and walk you through the steps. But my book does have the step-by-step instruction of how to open a Roth IRA if you guys are interested. We put the provider resources tonight in the Wealth Squad. So if you go to one of the very, very top of the Discord chat, it says provider resources. It's one of the chats. All of the providers in Wealth Squad are putting our resources in there. So you can find everything there as well. One-on-one consultations, my books, my resources, all that kind of stuff. So second question, it looks like the same thing. What if you don't have residency? HSA works with your health insurance. Yes. So health insurance is needed for an HSA, but on top of that, it has to be a high deductible health plan. And so for some people, it doesn't make sense to have a high deductible. There's different situations that I don't want to talk to everybody's, but if you don't want to spend, like, if high deductibles essentially is, hey, my premiums are low, but if I go to the doctor, it's going to cost me a little more. Where in reverse is like a regular plan would be totally opposite. It would be like I'm putting my, my premiums are a lot higher, but when I go to the doctor, they kind of cover me better. But yeah, you can open an HSA as long as that happens. Any recommendation IRA to look into? Yes. So I typically, everything I do and everything, all my investments are through Vanguard. I want to say they're the GOAT of investing in general. Like Jack Bogle, he was like the pioneer of index funds. You know, all of the books I read and all the things I talk about and educate on are specifically Vanguard, Jack Bogle type of stuff. But you can also go through Fidelity, Charles Schwab. You can get one through TD Ameritrade. I mean, pretty much wherever you can open one. But those are my recommendations. So your company contributes to your HSA if you get health insurance through them. Yes and no. So so that's a good question. There are some companies that say, hey, if you have an HSA, I'm going to contribute $500. 500, like for me personally, like my company does $500 a year. So basically they break that into, I want to say 26 pay cycles. And that's like, works out to be like $19.26. If I remember correctly. But basically every single paycheck, they put $19.26 all the way up for $500. I don't have to put any money in there. But I can. So I contribute myself $1,000 into my HSA as well. So then they also put $500 in there. So that's $1,500 a year. My wife does that as well. So there's $3,000 a year we're investing into HSAs. And it doesn't necessarily matter if you contribute or not. Like they'll still contribute if they're going to. Like there's no like, hey, I'm going to match you X% with HSAs. It's typically $500 from what I've seen through different health insurances. Why do I prefer Vanguard? I kind of just briefly talked about that, but mainly with Vanguard, guys, it's low fees. They are exactly the type of investment platform that I look for: long-term wealth, slow, steady type of stuff. Low fees, great customer service, best investment options out there. Easy to use platforms, stuff like that just appeals to me. Very reputable, I would say top 3 reputable firms in probably the world when it comes to investing. So that is kind of why I prefer them. I will be honest, Vanguard's kind of where I started. So like my 401k through work was at Vanguard. So it was nice to have everything consolidated there in the beginning. So I kind of, as I, added more and more investment accounts, it was easier to just keep everything housed in Vanguard. So when I update my balance sheet or something quarterly or weekly or whatever I do, I can just go into Vanguard and I can see all my accounts. I can see my taxable brokerage. I can see my 401ks. I can see my IRAs, all that kind of stuff. What are your thoughts on FFIUL? Was recommended from a friend about it, but still wasn't clear about the whole program. Is there a way to get money I've already put in and cancel it? So FFIUL, I know that's Index Universal Life. I don't know what FF stands for, but this is my take on Index Universal Life. This is a very, very common, and typically every time I hear this question, it says, hey, I was referred by somebody. The reason that is because commissions are very, very high for the seller. And they're going to push this product because they get more money in their pocket if they push it. I am not a fan of Index Universal Life. So this is an insurance product, and I do not mix my insurance with investments. I simply put I have term life insurance. We have $500,000 policy on both of us. Everything else is going to investing. So typically on average, a whole life insurance policy such as this is going to be 10 times more expensive than a term life insurance policy. So I'm a CPA, so I have the AICPA is like an organization for CPAs. So I get my life insurance through them, so it's a little cheaper, but we pay $38 a month for both of us. So I pay $20, she pays 18. But then at the end of the year, we get almost we got a 54. We just got the refund this month, or in February. We got a 54% refund. So essentially we were cut in half. So 38 divided by 2 is $19. So I was basically paying $10 for a $500,000 policy. She was basically paying $9. So it's extremely cheap, and it was $500,000. If anything happened to us, we'd both be covered for $19 a month. Whereas whole life insurance might be $38 because they're not going to get the AICPA discount times 10, $380 or something crazy like that. The reason being is because they put a portion of that they don't just take the 10, it's not just 10 times more expensive for no reason. They do take a portion of that and put it in a cash value. And they let that grow, at within a index, hence the name Index Universal Life. And they'll put it in like a S&P 500 fund. They'll let that grow. The problem with this is there are floors and there's caps. So the floor, you can't go below 0%, but which is the benefit, and that's what they try to sell you on. The cap, though, however, is like 15%, 12 to 15%, depending on the plan. And most times the market goes way above 15 to 12% in the short term. So you're losing out on so many gains, and they're going to sell you on, well, if it drops, you're only at 0%. It's foolish to even begin with that, because you can just basically pay a 1/10 of the price with term life and then go ahead and invest the 9/10 into the market in let's say a taxable brokerage account, and just let the market do its thing. But again, people are going to be very aggressive with this product. So it doesn't surprise me. You can take your money out. There's probably going to be some sort of a fee, but it might make sense long-term if you have just started it. I can't tell you what the fee is, but just talk to them. You definitely can take it out. They're going to pressure you as normal to stay in, to say, I don't know what I'm talking about type of thing. And this is an awesome investment strategy. I tweeted about this the other day, actually. This is meant for maybe 1% of people, and it's sold to 100% of people. So there is a piece of this that makes sense from a tax strategy perspective for the elite, wealthy elite people that are just like way above any of us. But it does not make sense for the average person getting into this, because there's no tax benefits to it. They're going to sell you on it, but there's just not. Can you set up a U.S. company and pay U.S. tax for the director, have us U.S. tax residency? Can you rephrase that question at the bottom? I apologize. I don't really understand what that means. What if you're self-employed? That's a good question. So if you're self-employed as and I left this off my presentation, but fantastic idea, is because I'm going to be self-employed here soon. So there's what's called a solo 401k or a SEP IRA. So they essentially are kind of the same thing. There's benefits to each one in different ways, but it's basically a 401k or an IRA that you can open as a self-employed person. So you would go through Vanguard just like you would for other accounts, and you would just open a SEP IRA or solo 401k depending on the benefits that you want. Typically for like an individual, if they're just self-employed and it's just them, they don't own like a business that they're paying employees, it makes sense to mostly do SEP IRA, but I've heard benefits for the solo 401k as well. At some point in time, can you withdraw from the HSA for something other than health expense without penalty? No. So if you put that money in there, it's for health related expenses. Like I said, you can pull it if you paid out of pocket and save the receipts type of thing. But if you pull it, for other reasons, there is a penalty associated with that. So it's something to be aware of. However, people underestimate health because it's not expensive, or it's not exciting. It is expensive. And the average person, like I said, spends a lot of money on health, especially if you have kids and stuff like that. I'd be hard pressed to say that you won't be able to max out that and withdraw that whole account at some point due to medical expenses. Just because the medical industry is expensive. I mean, I've torn my ACL and my meniscus 3 times in the dating back to like 21 years old. I did it like 3 times. And so my bills are outrageous, and I had to pay those every time. Right. And that they might run me $4,000, $5,000 in total. And so having medical expenses stashed away should be a fundamental piece of your budget and fundamental piece of, investing in general. But again, it's not exciting. No one wants to save for medical because ideally you don't want it to happen, but it's just a matter of time. It's not if. What's the best way to convert an old 401k, employer 401k, to a Roth IRA? I don't know if there's a best way. You can just basically do a rollover. So you take your 401k at your old employer and you move it, let's say, to Vanguard. You move it into what's called a rollover IRA. And then you take the rollover IRA and move it into the Roth IRA. If your old 401k is Roth, then you owe no taxes on the conversion. But if it's traditional, your conversion from the 401k to the IRA will be taxed. So You can either opt to say, hey, I want to keep it in a traditional IRA to avoid the taxes, or I can take it to the Roth IRA and go ahead and pay the tax penalty. To best calculate that, you take your balance times your tax rate, and that's what you would write as a check to the IRS. Any recommended HSA? Yes, First Dollar. First Dollar HSA is, I think, the best HSA out there. That's who I affiliate for, and that's not just because I affiliate for them. I don't affiliate for anything that I don't believe in, and I have walked through that product online. It is fantastic. It takes away every pain point of the HSA that people deal with on a daily basis. It has a portal for receipts. In short, here are the benefits. Portal for receipts, so you can just upload everything there. You don't have to put in your email or anything like that. The investment options are through TD Ameritrade, so you can like invest in like low cost index funds like VU and all that kind of stuff. Investment options usually are very, very limited in HSAs, depending on which bank you use. And then lastly, there is a comparison tool in there, so you can actually compare if you have a subscription or prescription. That you're picking up, you can actually compare the lowest prices around town so that you can find that. And it's their platform's incredible. So I highly recommend First Dollar. If you guys want a link, just let me know and I can send it to you. Just DM me. Can you live in a house bought with money from your HSA without withdrawing it from the tax status? No, I'm going to say no. I don't really fully understand that. But no, you can't live in a house with HSA funds if that's what you're asking. Thank you, Renee. Thank you. I've seen you provide many resources online. What's the name of your book you reference, and does it provide suggestions of what to invest in? Yeah. So like I said, my resources, guys, if you guys want to see a quick, dirty version of everything I have to offer, you can always go to my link in my bio on any of my social media platforms and just scroll through there. Everything's provided there. Also in the provider resources tab in the Discord chat, we just uploaded all of our resources by provider tonight. So that's literally a couple minutes ago I uploaded all those. But in short, I have an academy. So I have Budgetdog Academy, which is essentially in short a step 1 through step 10, I guess you could say, of personal finance. So everything personal finance related to get you on track, to make sure you're set and ready to go. I have a free investment tool. So if you're trying to compare like different investments from, let's say, Robinhood versus M1 Finance, I have an investment tool that you can do comparisons on. That's totally free. I have one-on-one consultations all the time. Those packages vary and stuff, but I work with clients all the time. My store, my Budgetdog store, which is the Shop Now feature, that has my book, and that's Investing 101, Everything the Investor Needs to Know. It does provide suggestions of what to invest in. It does not give you advice. It does not say, hey, you should invest in X, Y, and Z, but it pretty much indirectly tells you what's available, what I recommend, what I personally do currently, and all that kind of stuff. I have a 401k ebook specifically. It's way less in stature than the Investing 101, but it does cover all 401ks. It's obviously 401k specific, so it's like 20 pages versus 75 pages. I have a debt-free payoff calculator. I have workouts, 10 weeks of workouts for like $1. And then I also have a budget meals for the busybody, which is like a 17 recipes for healthy, convenient, quick meals that you can make. If you go to my IG highlights, you'll see my wife make all those meals live, and you can see what you're going to get. And then lastly, I have the bundle, which kind of bundles all those products together for 20% off as well. So that's a highlight of all the resources I have to offer. I have an HSA, but I haven't invested in it yet, and I believe they do it throughout Betterment. Do I have to designate where I want the money to go and manage that? Is there a fee? Good question. So HSAs are going to be in a cash fund. It's like a bank account, essentially. Think of that, unless you go ahead and designate exactly where that money should go. So most HSAs have $1,000. This is another benefit of First Dollar. You don't, hence the name First Dollar. Your first dollar can be invested, is really what the name derives from. Some HSAs are going to have $1,000 or $2,000 limit. My wife's old HSA that she had through Fifth Third Bank had a $2,000 limit. So we had to put $2,000 in, then we could invest on top of that, which kind of sucks, especially if you're not using it for medical. and you want your money to grow, there is no fee to manage it. You just have to select it, kind of like your investment products in your other accounts. You say X amount goes to S&P 500, let's say VIX, whatever fund that you want to pick, and then your contributions going forward will be selected there. There's sometimes a fee in these HSAs. They're sometimes high fees or like a monthly type of service fee type of deal. You can typically get those waived if you actually call the HSA and the bank and ask them about it. They typically waive them. But First Dollar, again, does not charge fees on that, which is awesome. If you face bankruptcy or your assets in the Roth or 401k protected, I do not believe so. I have not dealt with bankruptcy cases mainly, like Chapter 7 or Chapter 13. I know a little bit about bankruptcy, but I haven't been involved with it enough to know details. I would assume no is the answer to this question. 401k and IRA or IRAs, I highly doubt those are protected by any sort of imagination. Can you transfer the HSA to your kids or family members? You can. So yes and no. You can't transfer the money necessarily to them, but your plan, your health plan is, covered through your, let's say a family plan, right? So therefore you can pay for your kids' doctor visits or whatever through the HSA, which is a really, really cool opportunity. Okay, I think this is the question before. So can a foreigner who sets up a U.S. company as a director, okay, pay tax to the IRS? Does that qualify from the health insurance policy and HSA account? Okay, I see. So if you are outside of the United States, but you set up a US company and you pay the IRS, it does not matter about that at all. It has to do with the high deductible health plan. If you have a high deductible health plan through that company, and that's really the qualifier right there. And so if you have that and you have health insurance through them, high deductible, that's when you can open an HSA. Can you transfer securities from a regular brokerage account to a Roth IRA and pay taxes on it then, or must you sell it and join the Roth IRA? Yes, you cannot. You cannot transfer money from a brokerage to a Roth IRA. That would be kind of a backwards strategy. You might as well just save money instead of contributing more into the taxable. Just the money that starts coming in and flowing, just go directly to sell it directly to your IRA. The reason being is because if you sell your brokerage account, basically you have to cash out to get that money to transfer. You're going to pay capital gains tax on there. So you're paying basically, like, let's say 15% of those gains to transfer it into there. So it doesn't make sense from a tax strategy to do that. Technically, you could sell and you could put it into the Roth IRA because, like I said, it's outside of employer. So you can just invest whenever. But yeah, I wouldn't do that though. The first retirement fund you mentioned, C, that's backed by the Fed. And if so, wouldn't the payout funds be at the risk of hyper? Yeah. So, the fund that you're referring to, I think, is more the G. C is common stock. G is government securities. But yeah, so you're right. I mean, if things did hyperinflation, yeah, it would be impacted by it. So that's a good point. But again, it's kind of like bonds nowadays. Bonds are extremely unfavorable, but there's a point in people's portfolio that it makes sense to have bonds at some point in time. I'm not saying right now is the time to buy bonds. Like I'm saying, the G fund is not necessarily the thing to buy right now. But yeah, at different points in time, they all have purposes. Is there ever a scenario where you wouldn't max out a Roth or contribute to a Roth IRA? I'm trying to think, honestly. Really, no. The thing I would think about is like, hey, if you were really aggressive about pursuing financial independence, retire early, the FIRE movement, and you knew that, hey, if I invest in real estate and get this real estate rolling, I'm never going to need to access retirement funds. And this is not recommendation or anything I would do myself. I'm just saying, thinking of a scenario where it might make sense. If you could build a real estate empire where you wouldn't need retirement funds, it might make sense to put all your money, earn money to the real estate and not do the Roth IRA. But other than that, it's pretty hard for me to say otherwise. Another situation, I can't think of one. I think you always should have your bases covered, like retirement and stuff, before you start investing in other things. Because if you try to do the freedom fund, the taxable brokerage real early, but you don't have your retirement covered at all, well, that's going to be an issue when I mean, unless your portfolio is ridiculously high where you can live off of it, it's still not tax favorable, one, but you're going to become 59 and a half at some point in time. You're going to be 65 and you're going to be wanting to access that money tax free. All that growth along the way is tax free. So it's hard, especially a $6,000 limit. I would always probably do that. I have a rollover IRA that I'm currently trading in. Can I transfer that money into a regular IRA? Yes. So like a traditional, yes, you can transfer it. I would recommend doing that probably just to get it out of the rollover. The rollover to me is kind of a temporary hold. And then obviously you could do a Roth as well. Can you set up your HSA funds as a brokerage account? I don't think so your HSA can be invested, but it wouldn't be a brokerage account technically. So yeah, you can invest your HSA, but your brokerage, it wouldn't be separate from your brokerage account. But you can invest in pretty much the same stuff depending on what platform you're using, which bank you use. My old HSA kind of sucked. There were like 8 investment options, very small plan through Bank of America, I think it was, and it was really bad. So it just kind of depends which HSA you're in. So I think I got through all the questions. We obviously went over all the slides. I'm going to open it up for conversation. If there's anybody that wants to shout out something, I will open it up now. So go for it. Bueller? Anybody? So I have 8 minutes. If that's all, I mean, that's totally fine. We don't have to go the full hour by any means, but if you guys do have questions, feel free to speak up now, and ask me, because this is the time.
This is Meeks over here. Thank you so much for your presentation.
How you doing?
How you doing? You said that all your resources is gonna be in the providers tab because you were
Yes.
mentioning something about personal finances and stuff like that.
Correct. Yeah. Yeah. So there's are you referring to Budgetdog Academy?
Correct.
Yes. So that's in there as well. I think that might be I don't know. You'll see it. If you go to provider resources or my link in bio, you're going to see all my resources. The personal finance specifically, kind of like where you set up, like I look at Budgetdog Academy as like the fundamental personal finance setup. So like I can tell you exactly what it walks through. It has you walk through the baby through the creating a balance sheet, creating a budget. It gives you this all walks through an example. So it's video based. It's through Teachable, and there's like an example, a mock example. I kind of walk through a family scenario, and then I have you create your own stuff. Then you walk through creating your financial plan. You have the fundamental rules that you have to follow. I have 3 investing tips in there that you basically ever need. And then I also have 2 products in there for free as well at the very end, which are the 401k ebook specifically, which is like $15 in value, and the Budgetdog meals, which is about $5. So it's like $20 extra for free on top of that. But yeah, that's provider resources.
Okay, thank you.
Yep. And something else to note about that, guys, is like so I do one-on-one consultations as well. So if you want more, like it's a video-based course and all that stuff. But if you want more like guidance geared to you specifically, it's better to schedule one-on-one with me, because the Academy is a video-based presentation that I've pre-recorded. So it's impossible to know your personal situation. I do help you walk through like the situation. Like it gives you a very, very good foundation. But if there are like really specific questions there, it's impossible to answer in a course, obviously. So I just want you to be aware of that fully.
I have a question.
Yeah, go for it.
Hi. So I'm the one that asked about the IRA rollover. So thank you for answering my question regarding that. So when I transfer that money to the regular traditional IRA, do I also have to designate that to different stocks or index funds? Because I read that somewhere you have to also designate it or invest it as well. Or am I
Correct.
incorrect about that?
No,
Okay.
you're correct. So this is one of the biggest things. I tweeted this the other day to save lives.
Yeah.
People invest a lot of times. They open one of these accounts, like an IRA, and they put money in, and they think they're invested, but they have to designate where that goes, because within that account, you can't just put money in, because it's going to go to what's called a money market account, or like a cash account, which is basically the same as
Oh.
your bank account. And so I've heard of horror stories where 30 years go by. Somebody's like, yeah, I've been investing in my IRA for years. And they realize it's been earning like 0.6%, like a bank account essentially, for
Okay.
30 years. And that's a tragedy at that point. So yeah, you have to select where it's going to go. Where,
So like an index fund, designated to an index fund like VT, SAX,
oh yeah, that's it right
VOO and
there.
stuff.
That's
Okay.
that's the kind of
Uh,
stuff I like right there.
okay. That's what I'm
Uh,
hearing. I'm reading that book, simple something
Simple
simple wealth.
wealth, simple path to wealth.
Yes, that
Dale
one.
Collins.
Yep. Yes,
That's one of my
exactly.
favorite books.
Okay. I'm not done yet, but I'm hearing that's what he keeps referring to, and I'm like, okay. But then also I'm reading in the chats and Wealth Squad that, by yourself, and also that Decade Investor. I'm sorry if I'm getting it wrong, but he's also saying that you need to invest in the IRA. I'm thinking that you just
Yes.
have to just put it away and set it, but I didn't know that you had to also designate that. So I'm
Yeah.
glad that I'm in this Wealth Squad to understand that. So thank you.
Yeah, no, definitely. That's a big thing, guys. Like I
Yeah.
always get scared that like somebody has like I checked my parents' account one time. I was like, guys, I just want to make sure you guys are doing this right. Like, because they don't really know. And they luckily had it in some sort of fund. It wasn't my favorite fund by any means, but it wasn't a cash account. But
Mhm.
that happens more times than not, that you wouldn't even believe after like 20, 30 years go by. And it's scary because you basically get nothing in compound interest.
Interesting. Yeah. So same thing for like index funds and ETFs. You can invest in that traditional IRA, both.
Yeah. So
Okay.
I have a good post on Instagram for this to kind of show you the layers of this.
Okay.
But I'll kind of visualize it for you. So basically, when you look at the layers of index fund investing, or investing really in general, the first one is like the brokerage account. So it's like Vanguard, Charles Schwab, like the company that you're actually with. Then
Right.
within there, you have to select an account like 401k, IRA, SEP IRA, all the accounts that we've talked about. Then
Okay.
within that, you have to select the actual investment, like let's say an investment fund, like you talked about VT Sachs, which is the total US stock market. But
Right.
and that's where it stops. But the VT Sachs, like if you own VT Sachs, that's an index fund. That's not the actual core investment itself. The core investment itself is all the US companies that you own within there. And that's
hmm
really what it gets down to. That's like the boiling point where you're making your money.
So I can just tell the brokerage account to just invest my traditional IRA in VTEX if that's what I want, and
Yeah,
or
exactly.
VOO. Okay. Cool.
Yeah.
Thank you.
Yeah.
I have a question.
Go for it.
Does the IRA or HSA accounts pay any form of dividends?
Yeah. So, okay. That's a good question, follow-up question as well. So within the accounts, guys, so as I said, there's a brokerage, there's account, and then you select the investment. The dividends come from specific companies. So like a dividend's essentially like, let's think that's a thank you payment from a company for investing in their fund. So if you go through a Roth IRA and you invest in your money's in cash, you will not get any dividends. But if you invest in like a S&P 500 fund or like a VT Sachs total market, you're invested in those companies that are going to pay out dividends, which in turn pay you dividends. So yeah, the accounts aren't the ones that pay you. Like HSA, like the same thing. You have to actually invest into a fund, and if that fund pays out dividends through that company, you will get paid dividends.
Okay, and is there a way to have that dividend reinvested like annually?
Yeah, that's a good point. I often say check the box that says reinvest your dividends. That's a huge piece. So the S&P has returned like 10% that you guys often probably hear about long term since like 1926. But of that 10%, like 5.7% is capital appreciation and 4.3 of that's dividends. So if you were to go throughout that entire period, that 100-year history essentially, and not reinvest your dividends, I think I'm trying to remember the math. So that $1, if you reinvested $1 or whatever, your money at the end of that time would be $197 if you did not reinvest your dividends. If you did reinvest your dividends, it would be like $10,100. So it's a huge difference when you reinvest your dividends, because that's a piece of the overall growth of the companies that people often talk about.
Thank you.
Yep.
That's cool.
Cool. So here's a question. Some are coming through the chat box. How can I catch you on IG? Budgetdog is so if you guys see here on my screen, Budgetdog, that's exactly my @ It's also the same thing in the Discord. You'll see me pop up as a Budgetdog. Long story on the name, but that's what it is. Thoughts on VT Sachs versus VFX? So the difference here, guys, is US stock market is the VT Sachs. That's 3,600 stocks. The expense ratio is 0.04%. And you have the large cap, small cap, and mid cap. Whereas VFX is 0.04%, same expense ratio, but it's just 509 companies, which is the S&P 500 technically. And that's how many companies are in the VFX. So you get like 2,100 more, or whatever the difference there is, 2,400 more stocks if you invest into VT Sachs. However, the weight of the S&P 500 is so heavy, it's like 90. It ends up being like 90% of the fund anyway. So if you own VT Sachs, you essentially own the same thing as VFX. It's very, very minimal. If you look at the like returns of both, they're like splitting hairs. So I have VFX personally. Sean has VT Sachs. I started off with VFX, so I never felt like switching it over to VT Sachs. If I were to start fresh, I would probably say VT Sachs for a little more diversification, but it's not really going to impact you too much. So HSA is technically a mutual fund. No, HSA is an account. So the health savings account is the account that you're in, and then the mutual funds that you invest in would be within that account. Is VT Sachs lower risk because of the number of funds it holds? Lower risk is a hard to say it's lower risk. It's very diversified. It's the entire U.S. stock market. And it's a really good foundational fund to have in your portfolio because you have no fees on it. It's 0.04%. If you are through Fidelity, it's like there's different ticker symbols. I think it's FZ Rocks, like I was talking about earlier, and that's 0% entirely. But at the same time, like that's minimal. That's not even any difference at all. So it's not necessarily a lower risk, but I think your portfolio should be predominantly VT Sachs or VFX for sure. I like to say for most people, at least 60%. I feel very confident in saying 99% of people, that's a pretty good foundation. But it's hard to give blanket advice for anything out there in finances. But it's kind of like the 15% rule for retirement. It's pretty foundational. And I think most people would agree upon it. Kind of same thing with 50 to 60% of the entire US stock market. Because I think if you owned a bunch of stocks, 20, 30 stocks, people would say that's pretty diversified. But the VT Sachs holds 3,600 stocks. So I think that's pretty diversified and even more so. So you can go on and look at the prospectus or that's the annual report the funds have to provide the investors. Also, the fact sheet will give you all the details on these funds. So I always love to go to, like, if I want to go learn about what's in these funds, I go to Google, I type in VT Sachs fund fact sheet or prospectus, and it's going to pop up. It would tell you what it is, the fund objective, the returns, the dividend history, all the facts about it, such as like how many stocks are in it, what's the expense ratio, what's the net asset value of the fund, what are the holdings, the top 10 holdings of the fund, and how much of a percentage of the total does that make up? I think last night I looked at this as I was tweeting. 29% is made up of 10 funds. in VT Sachs. It's like Apple, Microsoft, NVIDIA, Johnson & Johnson, I think made the list. Visa maybe made the list. Very, very popular big companies that you all have heard of. So that's all of the chat, guys. I will open it up for a few more questions, and then we'll call it a night. And if nobody else has anything, go for it.
I'm sorry, it's me again.
Good.
Are you familiar with Fidelity?
Very familiar, yes.
You are? Okay. So can I ask you, is the VTSAX similar to like FSKAX or no?
Exactly.
Oh,
yeah.
it is?
Yep. So FK Sachs is the same thing as, I'm trying to remember this exact. Look, okay, so I kept saying FZ Rocks was so FZ Rocks is the total market, and FK Sachs I think is VFX total market.
Or FFFFX. It says Fidelity Freedom 2040.
Oh, that's a target date fund. Stay away from.
So basically, stay away from that.
I don't like target date funds aren't bad. But if you're me,
it's stable.
It's stable. It's going to basically reallocate your funds to bonds and stocks and kind of redistribute that stuff. But I don't know. I think that it's too much in bond. It's too bond heavy as you get throughout your age. And I think you can actually just basically create your own.
Got it. Okay.
It's really just a bond allocation and stock allocation that constantly changes based on your age. So that 2040 means that you're going to retire at 2040. So it's targeting that 2040 retirement date. And therefore it's going to make sure that you're realigned, and basically it's like a robo-advisor kind of fund, but they typically come with a little higher expense ratio depending on where you go through. Like Vanguards are pretty low. They're like 0.14, but like some funds could be like 0.6 or pretty high. And I think you can pretty much create your own fund, lazy portfolio fund, by doing the same thing.
Okay. So this FSKAX is similar to VTSAX. Okay. That's because that's what they have on their brokerage, just equivalent to that.
Right. So if you basically just type in like VT, like if you're looking at Vanguard funds and you're like, hey, I want to find out the Fidelity equivalent. Typically what I do, now that I memorized most of them, I don't, but like literally just go to them and type in like VT Sachs Fidelity equivalent, and it will pop up right away.
Okay, got it. Yep. Okay. And then can call and have them designate. Okay.
Yeah, you can do that on your own, but definitely I call customer service all the time. They're like my best friends. Just because I want to make sure things are right, you know.
Right. Okay. Thank you so much.
Yep. Yeah, Renee, I don't know if that was FSCAX. I saw that in the chat box if that's the fund we're referring to. But yeah, guys, it was a great presentation. Had fun talking to you guys. Also, just make sure you hit me up in the Discord. If you guys have any questions, I'm always there to help and stuff. And then obviously on my Instagram or Twitter, there's a lot of free knowledge out there that you can go through and check out. So that's at Budgetdog across all platforms, Facebook, Instagram, and Twitter. But other than that, guys, have a good night, and we'll talk soon.
Good night.
See you guys.